the firm, we want to take this on. And the top question is, does this person want to do a deal? And if the answer to that first question is yes, we can usually figure out the right deal for them and work with them, whether it's over a number of months or a number of years to find the right deal. But they got to want to do it. If your business is worth, sort of market would dictate 100 million or 50 million or whatever the price would be, and you meet someone and they're, I'm not selling for less than 125. We're not going to be successful because, it's not just I'm writing you a deck, give me your business. You got to show the owners some love. You got to convince them you are the appropriate investor, the appropriate steward for their business, for their family's business, their legacy, employees, all these things. You can get your price, but you're going to have to take it in a truck.
Hello, everyone. Welcome to another episode of This is M&A. My next guest has built his career helping middle market founders and family-owned businesses navigate some of the most challenging transactions or most significant transactions in their lives. He's a managing director at CriticalPoint, a Los Angeles-based investment bank. Nick focuses in tech, media, and telecom, but over the past 5 years, he's expanded into consumer products, business services, and leading sell-side transactions across all industries. Before that, he was a director at DH Capital, advising on more than 10 billion in internet infrastructure, telecom, and SaaS transactions. He started his career at Deloitte and is a proud Villanova grad. The Los Angeles Business Journal recently named him a 2025 Leader of Influence in Banking and Finance. And outside of investment banking and outside of deals, his life is full. He has a wife, 4 kids, and when he is able to sneak away, you'll find him on the golf course. With that, meet my guest, Nick Cipiti.
Yeah, thank you for having me. Good to be on the podcast here and have you for one of the inaugural or first season, I'll call it, of episodes.
Yes, and I appreciate your time. Having 4 kids, you probably don't have much of it, and I know it's hard to break away and getting extra time to do some of the outdoor activities. So you and I will have to link up and do some golfing at some point.
Happy to do it.
Today, we're going to dive into the world of founder-owned exits. So deals where the owner doesn't always want to walk away, right? He still wants to take chips off the table, but at the same time, he wants to find the right partner. And these situations can sometimes be some of the most rewarding, but also some of the trickiest when it comes to M&A. So what we're going to do in this episode is we're going to unpack the human side of the deal, right? What happens when a founder isn't ready to let go and the creative structures that can help keep those things moving. We're also going to dive into the buyer psychology, right? How to leverage what really works when a founder doesn't need to sell and what that means for negotiations. And then lastly, we're going to jump into market realities, right? How today's sponsors are under pressure to deploy capital and why that tension sometimes shows up at the LOI stage and what sellers should really watch out for. So with that, Nick, let's just dive right in. Most of your clients are founder-owned businesses. Let's start with what's unique about working with founders compared to institutional sellers.
Sure, Steve. Happy to talk about that. We're fortunate here at CriticalPoint to work, primarily founder and family-owned businesses. Some of those have been in business for 3 years and some for 3 generations, and they all have their own unique story that goes about them. And when we are working with them, they've decided that it's time or near time to start looking at a transaction, and that can be bringing outside capital to help grow the business. It can be bringing in financing to pay themselves a dividend, or it can be an outright sale. And I think that with the folks that we're working with and folks here in the Southern California market, you're often balancing competing priorities even within their own company, right? Sometimes the priority for people is the highest price. Sometimes they want a certain type of investor, a certain type of buyer. Sometimes they want, a good home for their employees. And so for us, it is one, working with those clients and those prospective clients to discover what those priorities are, and then helping them to get to and achieve that goal. It sounds simple on the surface, but when you're going through a transaction, meaningful, life-changing transaction for somebody who has not done a deal before or has been a business owner or a steward of the business for the family for many years, it can create a lot of challenges. And we think we're well-versed at handling that.
Yeah, it's an emotional roller coaster, right? A lot of these founders have been part of their business for quite some time. So to that point, the ones who aren't ready to ride off into the sunset, what are some creative deal structures that you've seen for those founders who, want to allow them to still walk away with some chips on the table, but still stay in control somewhat, right? So what's that look like in your world?
Yeah, we've been able to do a few deals over the last several years, either minority equity or debt and equity combination transactions with either SBIC funds or VCs or other folks that will invest on a minority basis and kind of partner with the founder. A lot of times we're also doing majority transactions with institutional partners where the founder is retaining, call it 30 or 40% of the business going forward. With the founder businesses, there can at times be situation where they have taken it to sort of as far as they are capable or willing to go, and they want to either diversify from a financial perspective or bring in a partner who can be value added. And so we're working with the founders and business owners on the one side, and then understanding the investors on the other side to find that right part for people, right? Maybe all you need is capital. Maybe you need help with sales and marketing. Maybe you need help from an investor expanding to a different geography or with a CRM or ERP or whatever it is. And so investors today are first in bringing a lot of those value add resources to founder and family owned businesses. And it's our job here in the middle to find the right fit, the right investor, the right personalities in a lot of instances that are going to match up and, create success for both groups, post transaction.
What are some example questions, I guess, when you're talking to a founder and trying to identify whether, let's just say, like a minority deal makes sense, a recap or a rollover of equity? What's just all of those things? What's the right fit for them? Like, what's that process look like for you guys internally? Or what should they expect type of questions that might be coming at them?
Yeah, so it's funny, when we meet people that we meet them, they want to sell business immediately, right? They've reached an age to retire or start stepping away. They've reached a point where they'd like the money to go do something else in their life. And other times they've reached it where people are just looking for help, right? And so I think it is for us, it's incumbent on us to understand priorities of the founder, of the seller, and what those may be. Sometimes you think you know what they want going in, and then as you get to know them better, as you get to understand their goals and their life outside of their business a little better, you better find that goal. And oftentimes it's people, they think they know what they want. They think they know who the buyer of their business is. They think they know the right structure. And we've had several deals over the last few years where, they thought they were going to do a majority deal and they ended up doing, a minority equity deal. They ended up, doing a recap. They ended up selling someone who wasn't even on the radar, right, to begin with. And they've been running their business for 20, 30 years, right? And there are people out there that were able to bring to the table that are right partner for them that they just didn't know that they were looking for.
Makes sense. What advice, I guess, would you give a founder who feels the pressure to sell but isn't emotionally ready?
You got to be ready at some point, right? It's whether there are outside pressures people have, but we talk a lot with the people that are our clients. Most of them are running profitable businesses. They have big clean balance sheets, very little debt, and so the idea of needing to sell usually is not quite there, right? They have reached a point where they want to sell, right? And sometimes that desire of wanting to sell has been pushed by a lot of inbound interest or seeing people in their sector get acquired for attractive valuations, or seeing just market activity and people will get the kind of fear of missing out type of thing going. But for us, as we're evaluating clients as well, is this a good transaction for us as a firm? Do we want to take this on? And the top question is, does this person want to do a deal, right? And if the answer to that first question is yes, we can usually figure out the right deal for them and work with them, whether it's over a number of months or a number of years to find the right deal. But they got to want to do it. And that's something that we think a lot about when we're meeting clients, seeing people on the road at conferences, get introductions. It's where is this person's at, and do they really want to? Are they serious about transacting?
What are typically some of the red flags in that discussion for you, right? When you start having that conversation, they might say, yes, we're ready, but sometimes they might say that with some hesitation. There might be some other things that might signal to someone like yourself, or like, we better pry into this a bit more, right? Let's make sure this person really is ready to go to market.
For sure. Yeah, I mean, I think the easiest one is misaligned value expectations. If your business is worth, sort of market would dictate plus or minus 100 million or 50 million or whatever the price would be, and you meet someone and they're, I'm not selling for less than 125, and you're like, well, that's great, but we're not going to be successful together, right? And so I think it's sort of feeling out value expectations, feeling out, in every deal, there's a point where you have to have some level of flexibility, right? Whether that be on dealing with diligence or dealing with negotiating terms or having difficult conversations, both with the buyer or your employees or your customers or whoever it is. The people that are, maybe not going to perform very well in that situation, it can derail the deal down the road. And so we're worried about that. And they're just, I think as you do this for a while, you start to understand the little things with people, right? The last thing we want to do is start a transaction and have it sort of be a price check. They know they're not going to sell. They know they're not going to sell, but they want to run a process to get a feel for what the market says the value for their business is. And then, maybe they're going to do a deal at some point down the road. And so I think you pick up on the nuances when people are thinking that way. And in the end, we want to work with people that want to have successful transactions. And, if we are ending up in a situation where people are maybe not as serious about it, you're going to have everybody disappointed at the end. And so we try to, leave on good terms with everybody. And the best way to do that is to set both us and them up for success from the onset.
Yeah, I think from my personal experience and from being part of several of these podcasts with others, a lot needs to go up front to make sure that this person's deal ready so that you don't end up wasting a bunch of people's time. This is a good pivot point to talk a bit about the psychology behind this, where you have a seller who probably has a lot more leverage because they don't need to sell, right? How does that change the dynamics in terms of the negotiations and how the deal is structured, if at all?
Sure. So I think I mentioned, a lot of our clients are people who have, profitable businesses and clean balance sheets, right? And so we've had a business that has been making money for 10, 20, 30, 40 years or more. You've got a clean balance sheet, no pressures, you're performing, as I had said before, you're making the decision to sell. And so I think, we're part of our job is qualifying good buyers and good investors for founder-owned businesses. And the good ones that we are engaging with and frequently transacting with are the ones that understand, it's not just I'm writing you a check, give me your business. You gotta show the owner some love. You gotta convince them you are the appropriate investor, the appropriate steward for their business, for their family's business, their legacy, employees, all these things going forward. And so periodically you'll run into folks that are maybe a little less experienced, and they want the I'm writing you a check to be the hammer, right? You have to meet my terms, do my deal, and I'm gonna make you do it. And in certain instances where it's pure value maximization, maybe you do go down the path, but for a large majority of our clients and our founder sellers, they end up partnering with the people that, from experience and dealing with them in the market are, the founder-friendly investors, founder-friendly structures and teams, and have great references, existing portfolio companies and existing investments that had happy founders, happy sellers, post-transaction and after the next transaction as well.
Obviously, your role in this is extremely crucial for helping founders sell their business. And I think a lot of founders don't realize a large part of your role in this whole thing is you're there to coach them, to mentor them, to teach them what to say in these conversations, to guide them through this process smoothly, right? When you're prepping someone for, their meeting with the buyer, what does that typically look like? What's that experience? What kind of coaching could my audience learn from so they could start thinking that way?
Yeah, I mean, I think it's the more you talk about something, the better you get at it, right? The finer point you can make. With our head of investor meetings, we will oftentimes do sort of a mock meeting where we'll sit on the other side of the table from the management team, from the founder, and start asking them questions we know that their sub points are, or where they're uncomfortable talking about, or where they are maybe not strong. And so initially you get a lot of pushback from people of, hey, I've been running this business for, however long, I know it better than anyone's ever going to. Like, I got this, I can do this on the fly. And, I think that with those folks, we still insist, we still have meetings, but, after that, we probably admit you have to get better at articulating it, at making these points, right? Because they are running their business from an operating perspective for many years. And then in a very short, intense period of time are going through the sale process. And the questions you're getting are different. The perspectives of the people that you're on the other side of the table with are different than the people that you've been interfacing with for the last, number of years. And so I think preparation is key. And, our best clients, our most successful clients are people who are willing to take that advice and put in the work to be prepared for investors, prepared to talk about things, prepared to answer difficult questions in a way where they don't look, they don't look uncomfortable. They look like they're confident in their business and they're confident in their responses.
Well, and this is not just coaching for the founder, it's coaching probably for the whole C-suite, right? So you're prepping all of those guys for the interviews that they might be going through.
Yeah. It's coaching the founders, coaching the C-suite, and it's the business questions, the personal questions, the what do you want to do after the deal question, right? How committed are you, right? Some people, um, founders, C-suite, other key employees, they're willing to commit for a number of years. Some people want to be done in a number of weeks. And so it is having the right responses to those, having the good responses to how are you going to grow this business and take it to the next level with, this investor's help or with this partner's help. And so thinking through both the business answers and the psychology of that and ensuring they're seamlessly intertwined is a big part of our preparation process that I think is something that people are less prepared for from the onset than they think they are.
I definitely agree with that. I think even founders who feel they're ready to step away and want nothing to do with the business after it closes, right? I think even those founders oftentimes find themselves in a spot where once their phone stops ringing, they're kind of taken back like, wow, I'm not needed. I'm not the guy everybody's calling on right now. And it's great for a while, but then there's a subset of people who are like, well, hold on. I had this whole plan. My plan's changing. I actually want to get re-engaged in something again. And that's why you see these founders who found another company get involved again, right? So there's an emotional side that people don't really think of when they first start the process. And you get to the end of a transaction and all of a sudden it's like, well, I'm letting go of my baby, right? The way it goes, and no longer am I the guy that people are leaning on. So it could be an emotional roller coaster by all means. Just to tie out on the psychology side of things before we shift gears a little bit and start talking about the market realities, if you were advising a founder about to enter negotiations, what's the one thing you feel that they should need to understand about the buyer psychology that could potentially save them millions, right? Because some of these transactions you're working on, it could really have that level of impact. Any tips or tricks that you can give there from a negotiating with the buyer side?
Yeah, I think it is, there are two big parts of a deal, right? In terms of you're agreeing to when you sell your business, and it's price and structure or deal terms, right? And so we talk a lot with our clients and prospective clients and other folks about the balance, the interplay between price and structure. And so you'll get people where they have a number in their mind of what they want for the business. And maybe that's justified by market pricing, or maybe it is not, right? You get people that have a price in their head because a competitor or a friend or someone they knew sold their business for that multiple or that dollar value or whatever it may be. And they think they're better, they have a better business, or they deserve at least that number that it's out of the person got. And so I think when you have people who have those ideas of what they want, oftentimes, we talk about the balance between price and structure, right? You can get your price, but you're going to have to take it in a structured way, or you want a clean structure, you want to walk away and be done. Like you're going to take a little bit of hit on price. And so, I think particularly in today's market where there's maybe a little uncertainty with macro conditions and just a kind of a nuanced environment, that price and structure interplay becomes a lot more important to think about and important to prepare people for, right? So someone who thinks they're going to walk away all cash deal for their business, and now to get to their price or get to their value expectations, the buyer is saying, all right, well, you got to take some seller note, you got to roll over a little bit, you got to have an earnout, whatever it may be. We want to get people thinking about those kinds of deal structure, and first of all, what they're willing to expect, and then what we as representatives, as their advisors, should be working through with buyers, right? Oftentimes buyers will ask, hey, do they want a cash deal? Are they willing to roll? Are they willing to take a little bit of an earnout? I can push the gap on value with, some sort of structural component. And so we try to talk about that with people a lot up front so that we are getting them the best option, the best sort of mix, right, of price and structure to their objective.
Earnouts is a whole nother topic. You and I could probably schedule another podcast episode to go through. Are you seeing an uptick though in those right now? Kind of given the current landscape of what's going on in M&A, are you starting to see the rise of earnouts being used and leveraged a bit more, or what's that look like from a landscape perspective?
Yeah, I think we are. I think that we as sellers never want earnouts, right? And we try to avoid them just because once you sell your business, you are, particularly in a majority deal, you are losing control, right? It is at times, even though you think you did what you needed to get to your earnout, there are things that happen in the business, things that happen with the buyer, whatever that happens that is going to impact your ability to achieve the earnout post close. That being said, if you look at multiples and valuations in most sectors, in 2021 or 2020 compared to now, the multiples are down at, and, as a way to maybe get to a value you would have gotten a few years ago or somewhere close to it, that is the structure that the seller has to take. And you talk about then, what people want to do post closing. I think you see people then maybe a little more, if they have an earnout, they're going to stick around a little while longer. So I'm a seller. I wanted a clean cash deal. I'm going to be out in 3 months, 6 months after a probationary period. Well, now I just took, I don't know, 10, 15, whatever percent of the purchase price in earnout. I want that. I want to get that. And there's both the dollars of it and the pride of sort of achieving it as your last, kind of hurrah with business. And so now maybe I'm, as the founder and CEO, as a member of the executive team, I'm sticking around for 12 or 18 months to get there, as opposed to the 3 or 6 month transitionary period. So it's changing the structure a little bit, and it's changing sort of that immediate post-close future for some sellers.
So let's shift. You kind of touched on the market reality and where it's at today and what's going on in the M&A world. One thing I've been paying close attention to is overhang is continuing to grow, and sponsors are under a ton of pressure to deploy this capital. How is that shaping the buyer behavior right now?
It's interesting. In our experience, I think it kind of cuts both ways, right? We get a lot more inbound, hey, what's going on? Hey, what deals you have coming up, from sponsors than, maybe we did a few years ago. But at the same time, deals are as hard to get done as ever. I think we're seeing a lot of interest in the deals we're working on. We're seeing a lot of activity. A lot of people want to take a look, particularly at performing businesses, things that are quality assets or, high performing assets. But then once you get to maybe a little bit pre-LOI, but certainly post-LOI, diligence is tough, right? And, I think we saw in some of our deals, and there's some stuff in the market back in 2021 and 2022, and maybe before that as well, where, maybe buyers were, kind of doing 90% of the diligence or 80% of the diligence, and that's good enough. We've got everything kind of covered off enough, right? It was a more competitive environment, and that was enough to get past their committees and get past, their level of comfort to get a deal done. Now people are crossing every T and dotting every I, and, figure out that, $1,000 variance on things. And I think it's sort of, as much as buyers are wanting to deploy capital and are under, major pressure to do that, there is still the spenders element of diligence that is very much prevalent, which sort of is maybe a counterpoint to, how urgent are you to actually deploy if you're, taking everything to the very end on diligence.
Yeah, we've seen, obviously, ShareVault, we're the secure document sharing for these types of high stakes transactions. So we see the signals to what's happening in the market, and we are seeing deals stick around a bit longer, just like we saw during the pandemic, right? Where there's a lot more diligence being done to understand the supply chain effect of what was going on, right? And so we're seeing a lot of that now as well, where deals are just hanging around a bit longer because buyers are being more thorough on the due diligence process. And also what we're seeing is, it always will be revenue and EBITDA multipliers. That is a core component to how deals get structured and valuations and all of that. What's being leaned in on more is the operational aspect of businesses. How operationally efficient are they, so that when someone comes in and takes over, can the business run itself, right? We're seeing just a lot more diligence in that aspect. Are you seeing the same through your lens in the broader banking community?
Yeah, I think that's right. I'd be interested. I'm sure, I don't know if you guys keep stats on this, but I'd expect, what proportion of people that are ShareVault clients that are extending the term of their data room versus a few years ago. Anecdotally, I guess it's higher, right? Like, oh, we had a 3, 4, 6 month initial term. We need to do whatever, some number more months. I'd expect that number's going up, which I guess is probably good for your business at the all else equal.
Yeah, that number is going up. I could tell you if you're fundraising, that number jumped significantly. That market definitely took an impact. Good for business, but what's best for business is seeing the successful outcomes. And we try to help accelerate the due diligence process through the data room. But um, as far as we're talking about overhang. What do you think is kind of holding that overhang up? Is it valuation gaps? Is it the high cost of capital? Is it the LP pressure versus GP preferences? What's been your experience in some of those areas?
Going back, and it dovetails into this, your question about, operational focus. I think as we've gotten out of the zero interest rate, low interest rate environment into a higher cost of capital or situation, obviously it affects returns, but it's also affected what is needed from companies and what's needed from executives. And so for a lot of deals, I think you saw, before interest rates went up, the successful executives, successful CEOs, both of our clients, and then you see sort of the next step. You could also have like it's going to sound a little bad, but like a cheerleader CEO or just an evangelist CEO that would be very successful in kind of being publicly focused and pumping customers and sort of just being a lot more rah-rah. And, the businesses were good that week. It got people excited and built the investment case. And now as things are becoming more expensive, you have inflation pressures, you have tariff pressures, you have, a lot of employment, all these sorts of things. The more operationally focused CEOs and management teams are the ones that are experiencing success because they're managing a tighter ship, managing a tighter business, and, don't need the flexibility that lower cost of capital provides. They can do well in that environment. And so I think that, when you think about the broader market, I think people are still sort of in this adjustment period, which is slowing everything down. We're getting a little more certainty on tariffs. There's obviously the rate cut recently. I guess there's more anticipated potentially. And so I think that you're seeing maybe a little more certainty in things that were previously uncertain, but that focus on operational excellence and operational improvement, enhancement, however you want to put it, is going to, I think, remain a focus because people realize they need to be prepared for, weather the uncertainty in the higher interest rate, higher cost of capital environment.
Yeah, that's what we've been seeing. I would just say that those operationally efficient companies, they're great companies. They're good companies. They typically have the financials, the EBITDA, the revenue combined with that. Those companies are still selling. So even when I saw kind of the slowdown in the deal making happening, it didn't slow there. Good companies were still being sold, right? So
I would say I mentioned a lot of our clients having clean balance sheets, right? And what a lot of times that would mean is one, no debt, but two, probably an excessive amount of cash on the balance sheet. You've got whatever, $10 million EBITDA and $10 million in your checking account, right? From a financial perspective, you're sort of scratching your head of, man, you get a lot better leverage out of this, right? If you invest some of it or whatever else. I think you've seen people with those conservative balance sheets be able, on the private company side, being able to withstand a lot of the disruption a lot more, right? They can eat the tariffs for a little bit or not let go of their employees or stomach a warehouse move or, all these sorts of things that people have had to do over the last several years to pivot operations, improve operations. And none of these guys would say, I told you so, but it sort of is, I told you so, right? This was the way to be business for the long term, right? As opposed to just kind of focusing on shorter term cash distributions.
right, right. Well, part of that operational efficiency and how you scale and run your business, to layer on top of that, what ShareVault tries to encourage the folks that we talk to is stay deal ready, right? Like be deal ready. Do get your company in line way before you're ready to sell the company. Don't wait till you're ready to sell to think you're going to scramble to get everything organized and structured. Start thinking about it far, far in advance. Get in touch with the right team as soon as possible to try to assemble that team in advance so they can start helping you get to that stage where you're ready to go to market, right? It's so important. So to close out just on the questions, and I know I'm digging deep in some of these topics. What would be one mistake that you see over and over and over again that makes you kind of, I don't know, cringe, let's say, where you're like, founders, you can avoid this. Don't do this. Just to help our founders just think, what landmines should I avoid? What would be that one tip you can give these guys?
I mean, it goes perfectly with what you just said about preparedness, right? I think that people think they're more prepared than they are, and there's a lot of things that need to kind of coalesce and happen at the same time to have a successful transaction. And that's both within your business and within your personal life, right? A lot of these people or families own their business outright, but do you have the right trust set up? Do you have the right tax situation? Have you prepared with some sort of financial planning? Do you have your book and records all set up? All of that kind of goes in together. And one thing that I think is overlooked a lot is what do you want to do with your employees? A lot of folks that we work with, they have employees that are loyal. They've been with the company for a long time, and rightfully so. The founder wants to take care of them on the back end of a transaction. And what you want to give people shares, give people transaction bonuses, put them in position to succeed with the next buyer or what have you. A lot of time that's getting figured out either in the deal, live in the deal, or at the very end of a deal. And I think that you'd be better off and you'd better sort of align values, align incentives between the sellers and the team and your key employees and the buyers for that matter, if you're figuring out ahead of time and sort of having an honest conversation with yourself and with those employees. We have folks that are on the more organized side, and they can be ready for a transaction in a number of weeks or months. We have people that you kind of get in there and you're like, oh man, we got some work to do, and it may be a couple of years, right, of cleaning up books and cleaning up, if you have tax issues or litigation issues or whatever, you can have a hundred different things that could be a challenge. But being prepared and getting all that buttoned up as much as possible ahead of time is going to be worth its weight in gold as you get to the end of a deal and you can't change things, right? Sort of once you're in flight, you're stuck with what you got, and most things can be improved to your benefit ahead of doing that.
Yeah, you wanted, from my experience in getting deal ready, where I thought, hey, we're ready to rock and roll. We got all our ducks in a row. Oftentimes we find that we have skeletons in our closet that we didn't even know about, right? As we're going through the process that a banker or an M&A advisor helped us uncover, right? Or we just didn't even know that would be something that would come up in diligence and would be an issue. So I think that's why it's so important to get as far ahead of it as possible, because the 3 to 6 month preparation may not be enough. Sometimes it takes 3 months just to clean up and your cap table and your governance. If you've done a good job from infancy as a company, it gets a lot easier. But unfortunately, us founders and refounders, that's not the case. We're on this go mode, like, let's go grow, let's do all these things. The governance side kind of sits to the wayside sometimes. And so it could take a while to sift through that and make sure you have all your ducks in a row and are truly ready for diligence. So, well, this is great. I really appreciate all of your commentary on helping us talk about where the market's at today, what founders can do to kind of get prepared, letting me kind of probe into some of those things. But let's talk about you for a bit here. What you're doing today with founders, like, is there something in your early childhood that you can point back to? You're like, I understand why I'm in the career I am and where I'm at today. Is there something you can point back to in your life where you kind of made this shift where now you're like, I get it. Now that I'm in my role and now I look back when I was a kid, I was curious, I was interested in these things. Anything like that you can share with us?
I think that I don't know if there's anything specific, but I think it's you grow up in the financial world from a career perspective. And, I started my career as an accountant, which was a great background from just an understanding and, financial statement training and that sort of thing. And then fortunate enough to work on many transactions over the last several years. And I think it's the ones that, and you mentioned this at the onset, that you find most rewarding, that you build relationships with, identify with, are these founder-owned businesses. And you have to some level, these people are going through, these families are going through this one time, hopefully, right? Or maybe a small number of times. And I think that for me, what kind of keeps you hooked into these businesses and engaged in whatever is, one, like I mentioned, connecting with them personally. And two, there's a duty almost you have to, do well for people, right? It's not, if it doesn't work out, it's not like they're going back to the drawing board and, we can figure it out next year. It's, they have a lot of things going on in their broader life and in their business and with their employees and all the things that we've talked about, and years of preparation and decades of building a business that you as an advisor have a duty to, I think, to perform well for them and, get to the right outcome. And so it's not always the easiest situations. It's not always the outcome you thought you get to at the end. But I think when you do get to these successful outcomes, it's a lot more rewarding at a personal level. And, a lot of times you continue to have great relationships with these people after their transactions are closed. You see them out, you see them, we have some local clients, see them around town. And it's great to see, and you really, really see the appreciation. So you think at a personal level, it gets me up in the morning, gets me on in the morning to do it. You want to come and interface with these clients. You want to hear their story. And I mean, it's incredible, these awesome businesses people have built, ideas that you never have, or little niches that they've really, worked their way into and built, life-changing, generational changing businesses for them and their families. And so it's just a level of connectivity and a level of personal reward in helping them out is, the part I like about it.
Makes a lot of sense. Tell us, how can people get in touch with you? Your contact information. Why should they get in contact with you?
I'm sure you can find contact information online. We're pretty forward with our marketing, but yeah, I mean, anybody who wants to reach out, we have our website, criticalpoint.com, information on there, my email address, and Cipiti at criticalpoint.com. I'm always available. Love to talk to founders, love to talk to business owners. I think that if I were to be a seller of a business that I owned, I'd reaching out to folks like myself 18 months, 2 years in advance and starting to build a relationship, right? We've got great financial acumen, we've got great experience, we've got great connectivity with investors, but the best deals for us, the best deals for our clients are the ones where you build the relationship, you build the connection. And so I love to meet people sort of as they're getting the journey started from a transaction perspective and, work with them to help them prepare sale and help to build the relationship to be successful together going forward.
There's nothing more important than having a solid team behind you. Just like anything, as a CEO, you got to have a solid team of leadership. When you're selling your business, you have to have a solid team. You need to have that banker who has your back. You need that M&A attorney. There's 5 or 6 people in that mix that you need to have solid. So I'm sure our listeners are going to love this conversation. Thank you so much for being on the show. There's so much we didn't have time to unpack. And I feel like I say this after every episode. But there truly is. We could dive deeper into each one of these subjects for hours. So with that being said, I'd love to welcome you back to the podcast at some point and dive deeper into some of these topics. So thank you for joining us on this episode. That's a wrap on another episode of This is M&A. We'll see you in the next episode. Until then, stay sharp, stay deal ready.
If this episode sharpened your thinking, share it, post your take, follow the show, or drop a quick review and bring it into your next deal. We'll be back with more real talk from people who've been in the room when it counted. The views and opinions expressed on This is M&A are those of the guests and hosts and do not necessarily reflect the views of any company or organization mentioned. This podcast is for informational purposes only and should not be considered legal, financial, or investment advice. Always consult a qualified professional before making business decisions.